You've seen it, right? We all have. That person who knows nothing about investing, but somehow seems to be making an absolute fortune. It's kind of frustrating. So today, we're going to break down exactly why the dumbest investors sometimes win big. And it all starts with a story.
Okay, so I want you to meet Dave. Dave is going to be our guide through this whole thing. He's kind of the star of our show today, and his story, well, it's probably a lot more familiar than you might think.
So here's the deal with Dave. He's been trading for about 2 years, which in Wall Street time is basically a toddler who's just discovered matches. But hey, his portfolio is up a solid 13%. He just made a killing on some crypto meme coin, and his confidence, it is absolutely 100% through the roof. He's living the dream, talking up biotech stocks at bars, basically thinks he's the next Gordon Gekko.
So, riding this massive wave of confidence, Dave does what let's call him an aspiring trader would do. He calls up his broker, fudges the numbers a bit on his net worth so he can get approved for options trading, and then he promptly goes all in. His big play? Leveraged out-of-the-money Tesla calls. And his risk management plan? Oh yeah, it's pretty much just prayer. So, the first month, it goes about how you'd expect. $13,000 suddenly vanishes from their savings account, which, comes as a bit of a surprise to his wife. But let's fast forward just 2 more months. Reality hits, and it hits hard. The Federal Reserve hikes interest rates, the market takes a nosedive, and Dave's portfolio just completely craters, down a whopping 67%. Oof. Suddenly, he's not a market wizard anymore. And Dave's story? It really brings us to the core question here. Why does this happen? How do inexperienced investors, people making these incredibly risky bets, sometimes look like absolute geniuses, even if it's just for a little while? Well, there are a few really powerful forces at play.
All right, so the first piece of this puzzle is all psychological. To really get inside Dave's head, we need to talk about a cognitive bias known as the Dunning-Kruger effect.
To put it really simply, the Dunning-Kruger effect is when people who aren't very skilled at something massively overestimate how good they actually are. It's kind of like thinking you're a master chef just because you successfully made toast one time. The problem is, you don't know what you don't know, which makes you dangerously confident. And this curve, it just perfectly illustrates the whole idea. On one end, you've got people with low ability who think they're total experts. That's Dave, right there, standing at the very peak. And then on the other end, you have the truly competent people. And they often kind of underestimate their own skills because they're so aware of how much more there is to learn. And here's the real kicker. It's how this bias changes how you see failure. For Dave, his winning streak was undeniable proof of his genius. But his losses? Oh, well, that couldn't possibly be his fault. No way. It had to be market manipulation or some other big, bad external force. But, Dave's crazy overconfidence didn't just pop up out of nowhere. It was fed and amplified by a very, very specific market environment. So let's zoom out and look at the bigger picture that kind of created him in the first place. For nearly 2 decades, starting around 2009, we lived through the single greatest bull market in history. 17 years. Think about that for a second. An entire generation of investors has known almost nothing but a market that just goes up. And the scale of this climb is it's staggering. Over that period, the S&P 500 generated a total return of 715%. I mean, the market has basically been on an absolute tear for 17 years straight.
And a rising tide like that, well, it lifts all boats, even the really leaky, poorly built ones. In that kind of environment, you could have thrown a dart at a list of stocks, and you probably would have made money. It actively rewards high-risk, kind of irrational strategies, which makes the people who use them look incredibly smart. Okay, so we have the psychological factor and we have the market factor. Now let's get into the nuts and bolts, the simple math that explains why Dave's portfolio swung so wildly between total triumph and complete disaster. It all comes down to a single concept: beta. Now, you've probably heard the term thrown around, but really understanding it is absolutely crucial to getting why investors like Dave can have such violent swings in their portfolios. At its core, beta is just a way to measure a stock's volatility compared to the overall market. So, a beta of 1 means the stock basically moves in line with the market. If it's more than 1, it's more volatile. Less than 1, it's less volatile. Simple as that. This table is a perfect example. Let's take Amazon, with a beta of around 1.33. All that means is it's expected to be about 33% more volatile than the market. So, if the market goes up 2%, Amazon should, in theory, go up about 2.66%.
But, and this is the part people like Dave always seem to forget, if the market drops 2%, Amazon is expected to drop 2.66%. Beta is a total double-edged sword. And this brings us right back to our hero, Dave. Beta is the engine that powered both his incredible rise and his spectacular fall. So here's the key takeaway. Retail investors are often drawn to these high-risk, high-beta stocks. The meme stocks, the super volatile tech names. In a bull market, this is basically a cheat code. A high-beta portfolio will dramatically outperform the market, making its owner feel like the next George Soros. This contrast, it just perfectly captures the two sides of Dave's coin. When the market is flying high, his high-beta strategy has him celebrating at Nobu. But when the market turns south, that exact same volatility has him checking for job openings at Payway. The very thing that made him rich is the exact same force that makes him poor. So when you combine the Dunning-Kruger effect with a historic once-in-a-generation bull market, and you throw in a high-beta strategy, you get the perfect recipe for what we can call the bull market genius. It really all boils down to this one simple, powerful quote. When everything is going up, it is so easy to confuse pure luck with actual skill. It's easy to believe you've cracked the code when, in reality, you were just riding a massive wave. So the next time you see somebody bragging about their 10-bagger on a meme coin, or hey, even when you're looking at your own wins, it's really worth asking this question. Is it skill, a repeatable strategy built on solid principles? Or is it just the market lifting all the boats? The answer might be more important than you think.